Good morning, everyone. This is Marshall Giller bringing you the morning comment for December 31st. Well, with 1 day left in trading, the market went into reverse on Tuesday, selling what's been bought for much of the year and buying what was sold in order to square up their books for the year. Interest rates in both Europe and the U.S. continued to fall, encouraged by a surprisingly low minus 1.1% year-on-year CPI print from Spain for December. That foreshadows a fall into deflation for the Eurozone as a whole next week. Yet it was the yen that took most of the attention yesterday, as the weakness in Japanese stocks pushed dollar-yen lower, as usual. Now, the Aussie dollar rose as iron ore prices rose again on speculation that the Chinese government will take measures to boost growth and support the property market, such as discontinuing limits on house purchases. Now, that hopeful view was reinforced by the final revision to the HSBC manufacturing PMI for December, which remained in contractionary territory. A typical bad news is good news reaction. Personally, I think the Chinese authorities are aiming more to soften the slowdown than to engineer an acceleration in growth. I think investors will eventually be disappointed in their response. Moreover, iron ore is still profitable at current prices, and so I expect supply will continue to expand. That's likely to put downward pressure on ore prices and therefore on the Aussie dollar over the course of next year. Now, the drop in interest rates and the drop in the dollar supported gold, which closed yesterday at $1,203.53, according to Bloomberg. It closed on December 30th, 2013 at $1,205.05. Not a great performance, but given that German and Japanese bond yields are negative out to 4 years, it's not that bad either. I don't expect gold to do that well in 2015, as I think the Fed is going to raise interest rates. That should change the picture for the precious metal. As for today's market, there are no major European indicators out. The 4-week average for the U.S. initial jobless claims is expected to move a bit lower, confirming the improvement in the U.S. labor market. The Chicago Purchasing Managers Index is forecast to have declined a little bit in December, but pending home sales for November are expected to have rebounded from the previous month. That should support the dollar. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you a happy new year and solid trading.